Well, hello everybody and welcome to Fantastic Female Fridays, a brand new show being brought to you by VectorVest. Today we are going to talk about 3 ways that women are better investors. My name is Susan HayesCulleton and I'm going to be the presenter of the show, and over the next weeks and months we're going to learn a lot about how women invest differently and in some cases better, but more importantly how you can take advantage of the natural advantage that you have. Now, over the past number of years, I have been working in this area for quite some time. I've worked with thousands, in fact, tens of thousands, in fact, maybe even hundreds of thousands of investors over the years, and I've always seen that men and women invest differently. But in particular, there are 3 key ways that women manage their money differently in the stock market. Number 1, they actually outperform the returns that men get. Number 2, they can actually reduce the amount of volatility in comparison to their male counterparts. And number 3, they're also more consistent when it comes to implementing a strategy. So what we're going to do is we're going to consider all of those. We're going to think about each and every single one of those throughout the series, but also even in today's show. Now you might say to me, so is it all wonderful? Is it all great? Are men better than women and that's that? Well, not quite. Because what I also have to tell you is that generally women invest less in stocks. Women are more likely to keep their money in cash as distinct from invest in any risk assets. And thirdly, women are actually less likely to have confidence in their own ability within the markets. And there are 3 areas that I would like to address throughout the show as well. My own name, as I say, is Susan HayesCulleton, and I have been the Managing Director of VectorVest Europe since 2011. I'm a CFA, charter holder. That means I'm a Chartered Financial Analyst. I'm an author. In 2013, I wrote The Savvy Woman's Guide to Financial Freedom and have written 3 other books along the way. But also, and in particular, I am an investor. I am somebody that has learned how to manage my own money, and I direct and manage it myself directly in the markets also. So I'm going to be sharing some of my experiences with you too along the way. I want to tell you though, particularly what makes this show different, and that is that a lot of people assume that in order to learn about the markets and then in order to be successful in implementing a strategy, all it takes is knowledge. Well, I disagree with that. And that is because, as you can see here, what I believe the difference is when we take a look at knowledge, confidence, and resources. I think we need to look at all 3. I think it's not just about how much you know or how much information that you can get access to. I think it's also about confidence. And I think that clearly distinguishes women from men in this case, is that women in many cases need to build their confidence before they will go into the market. And we see this in lots of areas. We see this in the labour market. We see this in asking for a raise. We see this in a wide variety of areas. But that's okay. That's okay. We'll work on that. And also then, of course, it's about having the resources that you need. It's about knowing where to get the information or where to get help or advice or direction or learning or guidance or whatever it might be. And again, that's also what I want to help you with. So what makes Fantastic Female Fridays different than any other show that you're going to see is that we are going to sit here right in the middle of this Venn diagram. So what are you going to learn today? Okay, well, let's take it from the top then. Number 1, we're going to discuss in more detail how women invest differently to men and how in particular you can leverage that advantage. Number 2, we're going to talk about a specific confidence model. Now, you see, the thing is that building confidence isn't just about digging in and driving forward and hoping for the best and celebrating your successes. Confidence is made up of a number of things, and each and every episode I am going to take you through a model to build your confidence so that you can transfer what you learn at this show into any other area of your life, financial or otherwise. And so today what I'm going to talk to you about is motivation. If you can learn how to motivate yourself, you will find reservoirs of confidence that you actually may not know were there. So I'm going to take you through that. And then the third thing is I'm going to take you through a strategy that I use that really aligns with the way women like to invest. That's also what I'm going to do with you today. Of course, please do send in your comments or your questions into the show. I'm really and truly delighted to hear from you. Love to hear what you would like to discuss in the coming episodes, etc. And all of my contact details are going to be in the recording link or in the email where you found this video. Okay, so let's start off with the first point that I wanted to discuss today. And that is, when you look at how men and women invest differently, what can we learn? Okay, so what I'm going to do here is I am going to take you to a document that I believe is quite definitive around this issue. And this is called The Secrets of Women Investors. Okay, so let's go over here and take a look. Now, what you find here is a report all around how women invest differently. And as you can see, they do more research, they panic less, they get better results. And while all of that's true and all of this is backed up within the report, and so the report is available in the email or also on the site where you can see this recording. And from here, I particularly want to direct you to one key statistic and then another one that backs up the same point. And that is down here. And during an analysis of the 60,000 users of OpenFolio, an online investment sharing platform, found that in 2014, which was a great year for the markets, women investors that outpaced their male peers by an average of 0.4 percentage points. So on a good year, if we take one example, then we can see that women outperformed men by 0.4%. What about a bad year? Well, 2015, poor year for the markets. Women, on average, lost 2.5% compared with a loss of men of 3.8%. So as we can see here. So now when we look at a bad year, we've seen the same result. And you might say, okay, Susan, but they're, 2 years. Fair enough. They're relatively recent. They're consecutive. But how do we know that this is extrapolated out wider? And more importantly, why? Well, I'm going to tell you about why in a moment. But let me show you another piece from this report. And I'm just going to scroll right down here and look at this one. Is that from this source that tracked the trading patterns and results of nearly 38,000 households over a 6-year period during the 90s, for which they could identify the gender of the primary account holder. Men traded 45 times more frequently than women, and as a result, on average, earned 0.94% per year less than women did. There's your answer. There is your answer, is that one of the key reasons that women invest differently to men and thus get better results is that actually women trade fewer times. And why is that relevant? Well, for those of you who are not at all familiar with the stock market, when you buy a share, you have to go through a stockbroker, and that can be online or that can be in person, etc. But you do have to still go through a broker. And when you do that, you pay a fee. And then when you sell, you pay a fee. So the thing is that no matter what happens, whether you buy or whether you sell, you still have to pay a fee. So as a result of that, if you trade over and over and over again, well, then you're going to be giving a lot of your returns back to the stockbroker. And actually, women do trade less. Now, you might also wonder, okay, trading, investing, are they just interchangeable? Do they mean the same thing? No. So speculating or trading, or as some people might call it, gambling, all of that is quite short term. This is when you are taking actions and you're hoping to make money on the stock market within days, weeks, minutes, hours, etc. Investing, on the other hand, is looking at the long term. And when you think about what the stock market is, it's basically a big supermarket full of companies that are available for you to buy shares in. You can walk into this supermarket through your stockbroker and you can buy pieces of these companies. And I'll tell you why the stock market makes sense over the long term is, I'm sure you all know somebody in business. I'm sure you all do, right? Does any business start off to fail or to make a loss? Of course not. Every business seeks to make money, but also to make money that is greater than if they had put that money, let's say, on deposit. So as a result of that, on average, over time, businesses do, of course, they find customers, they sell products to them at a lower price than what they cost, at a higher price than what they cost. They generate profits, they redistribute the profits among the shareholders, or else they'll reinvest to let's say, take on more products or to invest in their research and development capacity, etc. And if I was to take the entire long term, if I take, let's go really long, 100 years. If I take 100 years, the stock market delivers between 10 to 12% compound per annum each year. Now that's an average over 100 years. Individual years can be really up and really down. Any of you looking at the markets over the past 3 months will have seen major downs, major ups, sometimes on the same day. But that's all in the short term. Over the long term, the stock market does actually make money. It does deliver 10 to 12% per annum. So back to the trading point. So if you can take an investing approach, which is investing with the long term, looking at companies that have a good chance of making significant profits and that redistribute a significant amount of those profits back to shareholders, then that is what we call investing. And you don't have to do that very often in order to participate. Now you might say, okay, Susan, and I suppose you're going to tell me what are the companies that are going to do that? Well, you know what, I'm going to help you look for them and I'm going to show you where you can find them. But yes, I would like to teach you the fundamentals of how to find the like of these companies. So to finalize back on this trading point is that since women actually transact fewer times than men, that means that they generally might hold the winners longer, or that they might not sell losing stocks at the worst time, that they may wait until some of that volatility grows out. That means that often women actually do outperform men, particularly on that point. So one thing I want you to take away, and the first thing that I would like you to take away is, if you are already an investor, review how much you're spending on brokerage costs, and maybe there's a more cost-effective option out there. And I will show you in a couple of episodes' time how to look for things like that. But for now, simply review your costs and see, are there ways that you can reduce them? Look at your trading activity, see, do you need to transact as often as you do? Or on the other hand, is your transactions, are you not participating in the market enough? So just look from a stockbroker's point of view at your own account and see, is there any ways that you could make cost savings or to improve your participation? Now, if you have never invested before and you wonder, what am I talking about? What I'm talking about is, if you're going to set up an account with a stockbroker, watch out for cost. Because every time you buy and every time you sell, there's going to be a cost. And make sure to watch out for how much that you do pay for those costs. Before you ever set up, do your research there. And there can be hidden costs, etc. as well. So just make sure that you've got the full picture. Now, this show is going to be for everybody who is interested in the markets. You don't have to be a stock market guru. And similarly, for those of you who have been investing for a while, there's going to be a lot for you to learn too. Over the coming weeks and months, I'm going to talk to you about dividends, income, options, looking at value stocks and looking at specific sectors, etc. Did you know that women account for 70% of all purchases in the home in the US? We know a lot about shopping. And all the stock market is, and specifically investing is, are finding ways to shop for the best bargains or the best suitable shopping opportunities for what we need. So instead of buying organic food for dinner, or buying shoes for your kids to go back to school, or buying a present for your sister's birthday, investing is simply shopping in the stock market shop. So that's one of the reasons of how men and women invest differently. And another reason is that actually women are less likely to react to a major emotive change. So let's say a company comes out with a certain earnings statement, or let's say that the stock market goes through a really big crash. And sometimes these can happen just on days, as I say. A couple of years ago, in one day, a glitch in technology made the US stock market fall by 1,000 points in one day. Now, again, for those of you who don't understand what I mean by the stock market fell by 1,000 points, just take it from me, it meant a lot at the time. And the point is that generally women can actually tend to not react as quickly, and as a result take a more measured approach to see, is this really a problem? Do I need to take action? Or is my position okay? Will I maintain it and simply ride out the storm? And then the third thing is strategy. Is actually women are more likely to stick to a strategy. And again, all of this is in the reports that I'm sending to you. But the thing is that in order to stick to a strategy, you need to have a strategy. but also you need to believe in a strategy. And over the coming, again, weeks and months and episodes, I will talk to you about various different strategies, including today. But the point is that you need to find a strategy that works for you. And here's what a strategy does, is it gives you parameters. It gives you a method to examine an investing opportunity. So please don't think that every time that you might think about buying a stock or a fund, that you have to sit for 2 weeks and research everything about the company and take an accounting course and learn about its balance sheet and figure out what the CEO is having for breakfast. You don't need to do that. What you do need are ways in which to examine stocks, and you need to make sure that those ways fit with your own value system. That's what needs to happen. And again, I'm going to show you an example of that later on today. So they are the three ways. They're the three ways that women invest differently. So they generally get better returns, partly because they trade more sparingly and keep their costs low. Secondly, they tend to underreact in comparison to men. Not underreact in general, but just not overreact. And thirdly is they're actually more likely to stick to a strategy. And there's other subsets of this as well, which we'll get into as time goes on. But they're the three key things to take away. So what can you learn from that? Well, what you can learn is, number one, find a cost-effective broker, transact when you need to. Number two, how do you take the emotion out of your decision making? And then that's what avoids overreactions. And three, how can you get a strategy that suits you? They are the three key things to take away from that. Now, the second thing that I promised to speak to you about today is a model for building confidence. So I'm going to take you through that now. Here is one that I use all the time. And I'm going to show you this right here. And I am going to put it up right now. There we go. Okay, this is the model that we use around building motivation, which creates confidence. Now, again, like I told you earlier, what I want to do is to give you a model of confidence to use in every single situation of your life. I will apply it to money for you, and then you can apply it to whatever. So let's think about motivation, okay? Now let's start at the end, right? Let's start with the end in mind, as Stephen Covey from the 7 Habits of Highly Effective People said. I read a lot and I'll have lots of book recommendations for you over the coming weeks. But let's start at the end. Let's think about what you value, right? When it comes to investing, why does this matter to you? Why are you here today? Why does this matter? And over the years, when I've spoken to people, what they've told me is, well, I want to participate. I want to be in the market and I want to pursue financial freedom, or I want to pursue a greater lifestyle, or I want to make risk-adjusted decisions. I want my money to work hard for me. That's one reason. Another one might be, well, I want to teach my kids about money. I may not want to invest in the stock market, but maybe they might. And I want to be able to have conversations with them and direct them to learn. And then another one might be, well, I don't ever want to learn about investing for myself, but what I do want to do is understand how to have competent, confident conversations with my advisor. So let's take any of those values. And if you want, stop me right now. You can pause me and just think about what matters to you when it comes to investing. What matters? Now, in my case, by the way, it's all three. It is all three. I want and continue to be an investor. And I think it's a great life skill that makes an absolute difference to your ultimate wealth and also your ability to generate income over time. Personally, I don't have kids, but I work with a lot of young people and I want to be able to pass on the skills that I've learned about investing, long-term investing and managing risk. And thirdly, when I am dealing with an advisor, maybe it might be through a business, or maybe it might be through dealing specifically with a pension, or whatever it might be. I want to make sure that I'm able to have that conversation in a competent, confident way where I know the questions to ask so that I can get the information that I need. So you, as I say, take a moment, stop me, pause me, I'll be here, and just have a think about that. What matters to you? So now let's move back a step, right? So if I know what matters to me, then the next step in order to decompose motivation is that I need then to think about, well, what outcome do I want to meet that value? What outcome? And let's say that what I'm really valuing is my performance in the stock market. Well, then I might say, well, the outcome that I want is to participate in the stock market to deliver a return. Maybe it's the market return, maybe it's to beat the market, whatever it might be. And I want to do so in a risk-controlled way. And I know that if I have that outcome, then that will meet the value system that I have, which is to be an investor actively. If it is, I want to be able to teach my kids about money and specifically investing, well, then maybe the outcome is that I understand what risk, return, volatility, dividends, PE ratios are, that I want to be familiar with the concepts underpinning the stock market so that then I can teach them. And if it is an advisor, if it is that I want to be confident and competent when talking to an advisor, well, then maybe the outcome is I have a list of questions that I want to ask. I know the information that I need to seek out from the meeting, and I'm happy to have the conversation and ask the questions that I need to ask without feeling worried, oh, how is this coming across? So that's the outcome, right? That's the outcome. So they're the outcomes that we want, which line up with the values that we have. Now go back further. Now what we need to think about is what actions will lead to those outcomes, but that we believe the actions will actually work. Because I could easily turn on a YouTube video here and, have it on mute and walk around the house and not really look at the video and not pay an awful lot of attention. Like, that's effort, isn't it? I mean, turned on a YouTube tutorial about investing, that is active. That's doing something, isn't it? But you see, the thing is that we all know is that if you do that, that's not going to lead you to the outcome. That's the difference here. That's the difference. This is how motivation really works, is that you need to believe that the actions that you're taking will actually lead you closer to the outcome. So if I wanted to participate in the stock market and I know that I would like to generate returns, well, then the actions I might take are setting up a brokerage account, finding a strategy, and figuring out what type of investing characteristics suit me. That's what I might be. If it is that I want to teach the kids about money, and let's say that I know that I need to become familiar with the jargon, then I might buy a book on investing. I might take a course. I might commit to watching this show for the 30 minutes that it's going to run every single fortnight. And if it is that I want to go and I want to meet that advisor, and I want to be competent and I want to be confident and I want my list of questions and I want to know the information that I need to seek out. So what effort do I need to put into that? Well, I need to figure out, what have I got? What do I want? What are my hopes and dreams? What is my administration system looking like? Is all of my bank statements and credit card statements and everything just thrown all over the place, or is everything neatly put together so that if the advisor says to me, okay, so Susan, how much would you like to commit maybe into investing in a risk asset? By the way, a risk asset is something that's not risk-free. So cash might be risk-free. Stocks or bonds or certain types of bonds or property would be a risk asset. So you see, this is how we actually decompose motivation. This is what we do, is that you put effort into something that you believe will work, bring you close to an outcome. And that outcome is actually a useful outcome that leads you closer to your values. That's what motivation is all about. You can apply that to any area of your life. If you're struggling I really wish I had the motivation to set up my own business, or to learn more in a different language, or to go out and meet people, or to upholster a couch, or to renovate a room, same thing works. I use this model all the time. And what else I use it for is that if I found my motivation is dipping, I go back through these boxes and I figure out, where's the problem? Where is my motivation draining through? What's the problem here? Is it that I actually think the effort I'm putting in isn't going to go anywhere? Or is it that what I'm striving to achieve isn't all that important to me anyway? And this can be a super model. And I'm going to have one for you every single episode. I'm telling you, I will build your confidence by decomposing it, just like I've done there, by looking at individual subsections of it, and we're going to build you right up. Now, the third thing that I promised that you would have today is I promised that I would show you a strategy that is in line with the way women like to invest, which is, how do you trade sparingly in such a way that you are making a risk-adjusted return, or taking consideration into risk. How can we do that? And this is a personal preference. I want to do so as safely as I can. So let me take you over here to our program. Okay, so this is the VectorVest system, and I am in the viewer. Now, to those of you who aren't familiar with VectorVest, it is a platform that gives the people who use it, generally who tend to be either investors or people interested in investing, a way in which to analyze stocks and to manage their portfolio. And again, you're going to be sick of hearing me say this, but over the entire show, I'm going to take you through a variety of places within the system. So today, I'm going to take you to the viewer. Okay, so if you look here at the viewer is a really big spreadsheet of individual stocks. And in here, what I want to do is I would like to find the safest stocks in the database. And before I tell you how to do that, I also want to tell you what safe means. Is that in the VectorVest system, safe means predictable and consistency when it comes to financial performance. I would like to find companies that are predictable in terms of their earnings, that they make growing earnings year after year, quarter after quarter. And I would like to find consistent dividends, where a dividend is a payment made by the company to shareholders. Not every company has one, and there is a lot to learn about this area. But just let's take it, keep it really simple. Some companies pay out part of its profits to the people who buy its shares. So what I'm looking for in the VectorVest database is I would like in the entire US market, I would like the safest stocks in the database. That's what I want. And what I mean by safe is predictable earnings, consistent dividends. That's what I'm looking for. So I'm going to rank the entire database by RS, okay? So the way in which I have set up my system here is here's the company, here's the symbol, and here is RS. So now RS is an indicator. RS again is relative safety between 0 and 2. Above 1 is favorable, below 1 is unfavorable. So the higher the metric, the safer it is, the closer to 2, the safer it is. So you can see here that the safest stocks in the database as of today is, you can see here, Old Dom Freight, Fortinet, Tyler Tech, ASML Holdings, Salesforce.com, Alphabet, United Health, etc. Now, I'm going to take you through a particular strategy that we like here at VectorVest. I think this is really cool. And it's called the birthday game. And the birthday game is, I'm going to pick your birthday, and I'm going to pick any year that VectorVest has been around. It's been around since 1996, okay? And then what I'm going to do is I am simply going to imagine this scenario. Imagine that I bought the top 20 safest stocks in the database on your birthday in a certain year and hold them until now. That's it. That's it. Nothing else. Spend 20 transactions on holding 20 stocks. So what I mean is every time you buy a stock, you have to pay the transaction. So in however many years, all we're going to do is buy the top 20 safest stocks in the database on your birthday and hold them. Now, of course, I can't hear your birthday right now, but I can tell you what mine is, and we can go back to and we'll try this out a couple of different years, so we can try this out. Now, for those of you who have the VectorVest system, you can try this as often as you would like. For any of you that don't have this system, you can get a trial of the software and try it out, and I have something else to suggest to you as well later on. Okay, so but my point is that when you're managing a strategy, it needs to be simple, it needs to have parameters, and particularly the ones that women like are ones that don't involve a lot of transactions. And this is an example of that. Number 1, it's simple. Top 20 safest stocks on your birthday. Parameters. I'm not looking for anything else apart from relative safety. That's it. I am looking for relative safety, and that includes consistency and predictability of financial performance. Okay, so I have that, and as I mentioned, the other thing is that I want to trade as little as possible. In this case, I am simply transacting 20 times, 1 for every stock, and that's it. Buy and simply hold those stocks. So my birthday is the 15th of April. I'm an Aries, love to start things, which is why I love the idea of starting the show that we've done today. So let me go back here a good while. Let's 2003, right? Let's take April, 15th of April, and okay. And now I'm just going to find the top 20 stocks at the time. And back here, actually Walgreens is here still, Pfizer, United Health, Medtronic, S&P Global, PepsiCo, Harley Davidson. So imagine that I bought the top 20 stocks back in 2003. I'm just going to quick test them all from then until now. No changes, no stop, no nothing. I'm simply going to buy 20 safest stocks and hold them. That's it. Quick test all. And how would we be doing today? Well, here we go. I've compared this to the US stock market, the S&P 500. Don't worry about what that is if you don't know what it is. We'll talk about that another day. But it's just in comparison to the general stock market. So what I can see here is that this stock would have, this portfolio, a portfolio is simply a collection of stocks, would have delivered 262.78%. In fact, on an average basis, I would have generated 15.3% per annum. That means per year. That's pretty good. And this is actually better than the general US stock market. And that's what the birthday game is all about, is buying the top 20 stocks on your birthday and holding them throughout. Let's try another year. I could try any of them, but let me try another year. Let me go. Let's take 2005. 15th of April again. Press OK. And interestingly, a number of the stocks are still in here. Walgreens, Johnson & Johnson. I bought and sold that stock several times. Let me see. PepsiCo is still there. Pfizer. That was actually the stock I sold my first option on. Walmart is in here. I've also transacted on that before, etc. Anyway, let's now do the same. Let's take top 20 stocks, safest stocks in the database, buy on my birthday, hold until today. How would we do? Quick test all. And now this is actually an even better performance. In this case, I would have made 288.42% in total. And you look at this is interesting. Every one except one stock was a winner. Every one of them was a winner over that period of time, except for Walgreens has traded flat. That means that the share price didn't change all that much. And you can see there, so Johnson & Johnson delivered 108%. Medtronic delivered 81%. United Health delivered 533%. Danaher delivered 626%. So you can see the point again that I'm making is all I'm looking for is something super simple. Top 20 safest stocks in the database, buy and hold for the full period of time, and that's it. And in this case, this would have delivered 19% compound per annum that means per year, and whereas that actually outperformed the market significantly. So you might say, well, what difference does it make, Susan, if it's your birthday? Okay, and I get that you might ask that. You see, it doesn't make any difference. The thing is it's more so about if we pick a random date. Now, if I asked you for a random date instantly off the top of your head, you would say, oh, I can't think of one right now. That's the point. But you can all think of your birthday. So the whole idea around the birthday game is that it shows you by picking a random date and simply buying the top 20 stocks and holding them, look at the performance that happens. And the whole idea there is that it underpins the idea of long-term investing, of looking for stocks that generate profits and distribute some of those profits back to shareholders consistently and with predictability. And it's with a long-term approach, with simplicity, and by keeping the number of transactions to a minimum. That's what it's all about. And that was the strategy that I wanted to show you. I have lots and lots and lots more. But I just wanted to show you that one to get us started so that you can understand what characteristics of a strategy might be. So I've already asked you to consider how your brokerage costs are working out. The second thing I asked you to consider is just to use that model for motivation. And the third thing that I'm going to ask you to think about is if you have a stock right now, okay, if you have a stock right now and you want to check its relative safety rating, you might want to say, okay, but how safe is my stock? Is it very high? Is it very safe? Or is it not? Are the earnings predictable and consistent? You please do feel free to take a free stock analysis from the VectorVest page. So all you need to do is to go to VectorVest.com and look for the free stock analysis page. It'll be in the link, both in the email and on the page where this recording is sitting. And what you can do is you can take up to 3 per day for 3 days. So a total of 9 free stock analyses, and then you can check out, if you're looking at a stock or if you have a stock and you want to check its RS, its relative safety reading, you're more than welcome to do that. We're delighted for you to take our free stock analysis reports and check those out. And the relative safety is updated all the time on the VectorVest system, all the time. So you can always check back again at a later stage if you would like to. So it has really been my pleasure today to talk to you about how women invest differently to men, how we can lever that, and then secondly, how we can use the decomposition of motivation to learn how to build our confidence, as well as to give you an example of a simple strategy that really aligns in so simply with how women invest. I would love to see you again in 2 weeks' time. We will be going live again on Friday, the 3rd of July, 12 noon Eastern time. And I will be really delighted to see you. We're going to be here with you right throughout the way, every 2 weeks at Friday at noon Eastern time. The easiest way to make sure you don't miss an episode is to subscribe to the channel, which just takes a second. And then, of course, you will also be notified of any other VectorVest content that's happening. So, live here from Dublin, thank you so much to each and every single one of you for tuning in. And I really do hope that we will see you again in a couple of weeks' time. Thank you so much indeed, and every best wish. Bye.